Hi, and welcome to my channel, where I will be sharing my passion for personal finance and investing. I love researching income-generating stocks and ETFs, and on this channel, I will document my journey to building wealth and share everything I have learned along the way. Please remember this is not investment advice, and all investments carry risk. Always do your own research before making any financial decisions. Today, I will be talking about an income-focused investment fund that is not too popular on YouTube, but I think it is a very good one. This fund is called State Street SPDR Morningstar Multi-Asset Global Infrastructure ETF, and it seeks to track the Morningstar Global Multi-Asset Infrastructure Index. This is a multi-asset global infrastructure ETF, which means it invests in infrastructure assets around the world. It doesn't hold just stocks, but it also includes fixed income or bonds, and it's designed to balance income, stability, and diversification. The infrastructure side includes companies involved in utilities like electricity, water, and gas, transportation such as roads, airports, and railways, energy infrastructure like pipelines, and communication infrastructure such as cell towers. These are industries our society simply cannot function without. The index is unique in that it is equally weighted between equities and fixed income, with quarterly rebalancing. The SPDR Morningstar Multi-Asset Global Infrastructure UCITS ETF is a large ETF with over $1.7 billion of assets under management. The ETF was launched in 2015 and is domiciled in Ireland. The total expense ratio is 0.4%, which is not the cheapest, but I think it is an acceptable management fee for this type of a unique and defensive fund. Distributions are semi-annually, which is something to consider. Personally, I prefer monthly or quarterly distributions, but semi-annual payouts are not uncommon in the UK. The fund is available to trade in the USD, GBP, or Euro, giving UK and European investors more options. On the screen, you can see all of the tickers. Let's talk about why infrastructure investing is often considered defensive. Infrastructure businesses typically have stable, predictable cash flows, long-term contracts or regulated pricing, high barriers to entry, and demand that doesn't disappear during recessions. That's why infrastructure tends to hold up better during market stress compared to more cyclical sectors. But this ETF doesn't stop there. One of the main reasons I consider this ETF to be relatively safe, especially compared to pure equity ETFs, is its bond allocation. Unlike most ETFs that have a 100% allocation to stocks, this one blends infrastructure equities with fixed income securities. Why does this matter? Because bonds tend to be less volatile than stocks. They provide income from interest payments, and they act as a shock absorber during equity market sell-offs. This multi-asset approach helps smooth out returns over time, which is especially appealing if you are a conservative investor, you are approaching retirement, or you simply don't want extreme portfolio swings. This ETF will help you stay invested. I do like that this is a defensive fund made up of companies with a strong dividend-paying history. At the time of making this video, 46% of the equity weighting is in the utilities sector, followed by 37% in transport and infrastructure, 7% in communications and telecom assets, 7% in social infrastructure, 2% in energy, and less than 1% in medical care. The fund is also well covered across global geographies, reducing the risk of being overexposed just to one country. 52% of the fund's weight is in the United States, which I find is a good allocation. 7% is in Canada, 5% in France, 4% in the United Kingdom, 4% in Spain, 4% in Japan, 3% in Italy, 2% in Australia, and 1.5% in Denmark, China, and India. The remaining roughly 12% is allocated across 44 other countries, making this fund diversified beyond just the largest developed markets. The holdings are really well diversified, with no company having more than 2% of the weight, and the top 10 holdings having a combined weight of just 11%. Moreover, the largest holdings consist of some really good companies, with a very long history of increasing their dividend payments, such as NextEra Energy, Enbridge, the Southern Company, or Duke Energy. The dividend yield is currently sitting at a respectable 2.7%. The dividend growth streak is only 4 years, as the fund has understandably suffered and reduced dividends in 2020 and 2021. However, since then, the dividend growth has been very strong, averaging over 10% in the last 3 years and over 7% in the last 5 years. When it comes to price appreciation, don't expect a massive growth from utilities, infrastructure, and fixed income. That being said, the fund has delivered a solid growth of over 9% in the last year and a 13.5% over the last 5 years, with some price fluctuation due to the defensive nature of these companies. This ETF is not for everyone. If you're looking for explosive growth and double-digit returns, this probably isn't the right pick for you. But if you value stability, income, lower volatility, and long-term wealth preservation, then this ETF can make a lot of sense, especially as a part of a defensive, income-producing portfolio. In summary, this unique ETF provides stable cash generation through infrastructure exposure, stability, and downside protection thanks to bonds and fixed income, and diversification through its global approach. Let me know what you think about this fund. Have you heard about it? And would you consider including it in your portfolio? Thank you for watching until the end. I hope you have enjoyed the video. If you have any questions, please put them in the comments section and I will do my best to answer them. See you next time.